U.S. home insurers suffering their biggest loss in a century. That and more coming up today on Business Matters. Good afternoon, and thank you so much for being here with me. I'm your host, Don Ma. Markets first, as always. Looks to be a steady day down on Wall Street. All three major indexes little changed as we begin a new week. S&P 500 up about 4 points here, NASDAQ up 12 points, and Dow Jones down 49 points. And here's some big individual movers today. Tesla seeing green, up over 5% for the day. JP Morgan giving it the nod today as its best auto pick, replacing Ford. Now, Ford stock down 20% on the other hand in the last week. And Heineken shares down a massive 10% after a weak earnings report. We have details on that later. As well, McDonald stock up over 3.5% today after releasing earnings. We also have a full breakdown of that report later in the show and some other earnings reviews as well. Okay, 2023 saw the worst underwriting loss in a century for home insurers. And this is according to rating agency AM Best. It found that insurance providers were hit with a $15 billion net underwriting loss. So that's when an insurance company has to pay out more in claims than expected. So the report pointed to several key factors. Inflation, of course, natural disasters as well, and population growth. It noted that in 6 states, including California, Texas, and Washington, they accounted for half the country's population growth in the 2010s. AM Best does not see a likely return to underwriting profitability for home insurers in the near term. All right, moving on from that, the Justice Department is asking a federal appeals court to uphold law that would ban TikTok. It gives Chinese owner ByteDance until January to sell TikTok's U.S. assets or else be banned. The DOJ is expressing concerns about the amount of U.S. data TikTok can collect and how it can manipulate content to U.S. users. So the department has accused TikTok of being able to gather sensitive information. That's like users' views on guns, for example, abortion, as well as religion. And government lawyers claim that TikTok stored sensitive U.S. data in an internal system that ByteDance had access to. Of course, TikTok denies it, that it would ever share U.S. data with China or manipulate videos, and says that the U.S. has not shared proof of its claims. Over in the UK, the British government is warning Brits to get ready for some economic pain. So the UK announcing a raft of cuts to dig itself out of a $28 billion spending hole. So in a statement to the House of Commons, its finance minister pledged to make the necessary, urgent, and incredibly tough choices to restore the country's economic stability. So some cuts announced include the Restoring Your Railways Fund program, a tunnel to Stonehenge scrapped, and a review of a hospital expansion program. The finance minister had initially ruled out tax increases, but she needs to balance the pledges from her party, which include boosting to national investments and public sector pay. The Labour Party swept to power earlier this month after 14 years of Conservative Party rule. Meanwhile, an attempted transition to electric vehicles has rattled Thailand's gas-powered car industry. And that industry accounts for a massive 11% of the country's GDP. So the change started in 2022 when the government began incentivizing the import of Chinese EVs. Let's go to NTD's Sean Marshall now for the story.
Thailand government incentives for Chinese electric vehicles have allowed car dealers there to slash the price of EVs. This has sent shockwaves through the country's gas and car industry, leading to price wars, factory shutdowns, and layoffs. It's also left tens of thousands of electric vehicles lying unsold in warehouses and at dealerships. Data suggests more than half of all EVs imported from China since 2022 are unsold.
Well, I think the world is learning that If you build something, no matter how wonderful it is and how cool looking it is and how high tech it is, that doesn't mean that consumers will buy it, whether for one reason or another.
It all started in 2022 when Thailand's government offered Chinese manufacturers grants of over $4,000 per vehicle. It also got rid of tariffs on Chinese EV imports. The government was hoping this would speed up the transition to electric vehicles, but consumers didn't bite.
And the result is car manufacturers have to pull back, and they're going to have to go to hybrids, which is what consumers do like. You get longer distances between fill-ups.
The Thai government is now introducing incentives to shift towards hybrid EV manufacturing. It's looking to attract at least $1.4 billion of new investment over the next 4 years.
So you have to make what people want, and when they don't sell, then the manufacturers have to take the hit, even though the government mandated something that you and I didn't purchase.
Thailand also faces challenges building out its charging station infrastructure. As for America's all-EV push, Fix says continuing down the all-EV path too quickly will likely have problems. Sean Marshall, NTD News.
And here's some more China-related news. The country and Italy have just signed a 3-year economic action plan. This will implement past agreements and experiment with new forms of cooperation. So the announcement was made after a meeting between Communist Party leader Xi Jinping and Italian Prime Minister Giorgia Meloni. This comes just after months Italy dropped out of China's Belt and Road Initiative. This is one of China's signature policies. So it aims to build power and transportation infrastructure around the world and deepen China's influence over other nations. And on this topic, earlier I discussed it in more detail with Daniel Lacaille. He's the chief economist at Tres's hedge fund in Europe. Daniel, good to see you as always. So let's break this down here. What does it mean when Meloni says she's vowing to relaunch Italy's cooperation with China?
Well, I think it's a little bit of rhetoric, no, and a little bit of diplomacy, because Italy's relationship with China in terms of trade is enormous, no? The government data shows that basically there's about $18 billion in 2022 and rising of exports from Italy to China. And also that imports have also been rising quite significantly. The exports of China to Italy have more than doubled in the period 2019-2022. So Italy and China have a pretty strong relationship. I think that maybe what we're hearing is a message in which Italy is trying to separate itself from the messages of the President of France and the messages of the European Union relative to electric vehicles from China and trading with the Asian giant in general. But obviously, there is very little that can be done in terms of increasing more the levels of exports and imports from China, which are quite significant in Italy.
Okay, but I can't help but wonder, this new 3-year economic pact that was agreed upon between the two countries, because if you look back to the trade pact between China and the U.S., China never lived up to those agreements. So give us your thoughts on how this would play out.
I think it's a very good point, because the likelihood of China not living up to the agreement is significant if we look at the history of similar types of deals between the European Union and China, and also between individual nations and China. And we've also seen that with the Belt and Road Initiative. So it's quite challenging because it is very difficult to reach an agreement that is going to be beneficial for both parties and beneficial to economies that are already doing quite well in terms of exports. It's easier for China to multiply its exports than for Italy to do so.
So you mentioned earlier that perhaps Italy's move here may be more messaging. Does that mean China actually has the ability to do severe damage to Italy, and this is why Italy wants to be on its good side?
I think it's a good point because the automotive industry in Italy is very important. The green technology industry is also very significant for Italy, and it has quite a few called national champions in the country that are supposed to be leading the process in technology, electric vehicles, and in green energy. So in those areas, it is very, very difficult for Italy to compete with China. And it is more likely that the Chinese giants are going to benefit from Italy than Italy benefiting from China. Obviously, not just a question of costs, but also access to the level of minerals and the level of raw materials that are required for the green energy revolution and for the technology developments.
All right, Daniel, thank you very much for your time today, as always.
Always a good point. Thank you very much.
Now, let me go through with you some quick headlines, rapid fire style. Apple's first ever unionized store in the US is set to vote on its first contract. The union announced that it struck a 3-year deal to increase pay and other benefits. Toyota could have a new leader. Chairman Akio Toyoda now has the lowest support rating in company history. In an interview, Toyota said at this pace, he's not going to be reelected. Germany's Volkswagen and U.S. electric car maker Rivian can move forward with a joint venture. The German Competition Authority decided that there are no serious competition problems. And Deadpool and Wolverine have crushed the box office with a $205 million opening. The Ryan Reynolds and Hugh Jackman film is easily the year's best debut and the biggest debut ever for an R-rated film. Robert Downey Jr. is returning to the Marvel Cinematic Universe as one of the biggest villains. The Iron Man star shocked fans when he unveiled at San Diego's Comic-Con panel that he's going to be Dr. Doom. All right, heading to break now. Coming up afterwards, we have the latest breaking earning news, including how they're not loving it at McDonald's, reporting a surprise drop in sales worldwide today, its first decline in 13 quarters. Stay tuned. And thank you for staying with us. Some more headlines today, real quick. Credit rating agency AM Best says American insurers saw a record $15 billion net underwriting loss in 2023. That's when an insurance company has to pay out more in claims than expected. The report pointed to several key factors, including inflation, natural disasters, and population growth. The Justice Department is asking a federal appeals court to uphold law that would ban TikTok. It gives Chinese ByteDance owner until January to sell TikTok's U.S. assets or else be banned. The department has accused TikTok of being able to gather sensitive information from American users, like their views on guns, abortion, and religion. Britain has announced a raft of cuts to dig out of a $28 billion spending hole. Its finance minister pledging to take the necessary, urgent, and incredibly tough choices to restore the country's economic stability. The Labour Party took power there just a few weeks ago. And just in, breaking earnings news, Lattice Semiconductor core falling a massive 10% in after-hours trading. The chipmaker's revenue and earnings per share both missing estimates. German brand Tilray gone the other way. Its shares up 10% after the bell. Tilray is a global lifestyle consumer packaged goods company. It saw a 26% increase in net revenue. And some earnings from earlier in the day. Investors were disappointed by Dutch brewer Heineken. Shares down a massive 10% today, despite a rise in half-year operating profit and a raise in full-year guidance. An anticipated boost from June and July sporting events did not materialize, and Heineken was on the hook for a nearly $950 million value loss of its Chinese partner, China Beer Resource. Another Dutch company, medical device maker Philips, has beat analyst expectations in the second quarter. Shares up 13% today. This was attributed to cost savings, particularly from cutting jobs and a payout linked to liability claims. This year, 1,000 jobs have been cut, with more expected. And the company received insurance income from liability claims related to its recalled respiratory devices. And a rise in insurance premiums and higher returns on investments helped insurance firm Lowe's report a jump in Q2 profit. Shares down 1.5% today. And McDonald's sales drop worldwide. The first decline in 13 quarters. Revenue fell about 1% with sales of around $6.5 billion. In the U.S., revenues fell 0.7%. CEO Chris Kempczinski says that people are more money conscious.
We've seen more markets have the same sort of slowdown, and it is certainly most pronounced with that low-income consumer. The consumer is eating at home more often. You're seeing more deal seeking from the consumer.
And of course, inflation still problematic worldwide. So cooking at home still cheaper than eating out. Even McDonald's itself is struggling with inflation. Kempczinski says that its costs have gone up 20 to 40% depending on the market.
We look for ways to protect restaurant profitability via productivity efforts and selective price increases. These price increases led consumers to reconsider their buying habits.
So what does this say about the economy? McDonald's is the first major restaurant to report this quarter. The others have not yet reported. Last quarter, they did not perform well. Burger King and Wendy's saw slowing sales growth. Starbucks as well, along with Yum Brands, which owns Pizza Hut, Taco Bell, and KFC, saw revenues decline. And for a clearer picture, we are joined now by restaurant consultant Izzy Karish. Izzy has advised over 700 restaurants throughout his career. How are you doing today?
I'm doing great. How are you?
I'm good, thank you very much. So McDonald's reporting weak earnings today. Do you think this is because of the consumer's ability to spend diminishing here? What do you think?
Well, it has a lot to do with perception. The low prices that McDonald's had before meant an American consumer could spend well under $10 and get a full meal. But since their price increases, now they're in the double digits, $12, $14. And that does all of a sudden make that, lower economic consumer look at that and say, wow, I can really go to the store, buy food much cheaper, cook at home. But the other side of it is for the consumer who used to run to McDonald's just to get something quick to eat at a low price. But now the prices are so high, that same consumer can look at it and say, you know what? I can go to a full service restaurant and spend just about what I spend at McDonald's and have full service. Somebody brings me the food. So that price jump has put McDonald's and other fast food vendors into a whole new category.
So do you think this strategy from McDonald's of the value meal, the $5 value meal, do you think that's going to attract back consumers?
It's going to attract consumers, but I think on a much shorter term basis, because they really have to keep that up for quite a while to turn people around. It was, you had a consumer that was used to eating at McDonald's before for a very low price. Prices are up easily that 40%. To get those consumers to all come back, it's going to take a really long-term strategy. And certainly the value meals is a good start, but how long they will be able to hold on to that consumer is going to be the determining factor.
So, I mean, in your view then, what does McDonald's have to do? What is its strategy going forward to bring back those people?
Well, not only is it going to be the value meal, but it's going to be the everyday meal, getting just a cheeseburger and fries and a soft drink for a more reasonable price. So I think they're looking at how do we bring that perceived value back into the marketplace to where it's perceived that McDonald's and the fast food places are a big savings and a regular place to go. But we've had over a year of these higher prices, and essentially what has happened is McDonald's and other fast food restaurants have trained people that for about the same price, you can go elsewhere and get a full service meal. So the road to bringing those people back is going to be much longer.
So you have tremendous exposure in this sector, in the restaurant space. So how does the broader sector look like? Is activity slowing down in this space?
activity is slowing down. And what is happening is that the consumer is going out at the same rate that they were, let's say, a year ago, but that same consumer has reduced their own spending by 20 or more percent, 20 to 25%. What does that mean? If I go to a full service restaurant, I might now get either a cocktail and a glass of wine with dinner versus, before I would have both. Now it's going to be one or the other. Instead of having my own appetizer, I'm going to share. And I'm going to share an entree. And I might share a dessert. So we like going out. And we're doing it at the same rate, but we're spending 20 to 25% less, which means the restaurant has to have 100% of the employees for a customer base that's spending 20% less.
All right. Thank you very much, Izzy. Pleasure speaking to you.
You too. Thanks so much.
And that's all the stories we have for you. Thank you very much for watching. If you have any feedback for the episode, please feel free to let me know. You can email us at business@ntd.com or leave a comment online. I do read them for every single episode. Thanks again for watching Business Matters. We'll see you tomorrow.